Hey everybody, welcome back to the Financial Freedom Show. My name is Rob Berger, and yes, this is a different studio. I am hoping you can hear and see me. I'm also kind of hoping that the audio isn't horrific. It could be. I don't know. I'm looking at my screen, and I can see that this setup, I'm throwing things on the floor, is a lot wider. You can see the desk. I'm a little further from the camera. So please give me a thumbs up if this is at least halfway viewable. Oh, audio sounds good. Thanks, Paul. James, all right. Tyler, Kelly, thank you. So yeah, I don't know if this is permanent. I kind of joke and say that my wife will let me know. That's 33 years of experience right there. I'm going to tell you that right now. I actually kind of like it down here. See, and I got my, see the quote unquote Red Sox thing behind me, I guess over here, is closer now so that people will stop emailing me and saying, what's up with the Red Sox? Anyway, and I've still got my wife's picture. Yeah, you can't forget that. Pretty much everything else is not mine at the moment. That's okay. So if you're new to all of this, this is where I do my best to answer your questions. I'm not a financial advisor, nor do I play one on TV. But I've invested for 3 decades, I guess. And, happy to give you my opinions on just about anything, by the way, including fitness, nutrition, chess, very few questions in that regard. I did order a Rogue fitness sled, which I think I mentioned in the last show. Pretty excited about getting that. All right, so I see the questions. If you want to ask me something or want me to discuss a topic, just tag me at Rob Berger in your comment, and it shows up orange for me. That'll be helpful. I will have timestamps. I was really slow getting them up for the Monday stream, and that's all my fault. Just because of all the work we've had going on in the house, which we're not doing a lot. It's basically some insulation and painting, but it's been a little disruptive. So in any event, I have no excuses now. I think I'm out of excuses. I titled this show about global investing with what's going on in the world. And as I've thought about everything, it seems to me, and I know there are a lot of folks that just want U.S. stocks, and I get that question a lot. I've been a big believer in investing in international funds, something that Warren Buffett had suggested just S&P 500 for most people. But what does he know? I mean, really. And then Jack Bogle, he was a big proponent, I think, of U.S. only. I'm just not. And for me, and I'm going to show you something here in a second. For me, what's going on in the world right now actually underscores the importance of international exposure. That may seem a little odd, particularly if you've got exposure to the Russian market, which actually, let's look that up. So let's go to, let me put this on the screen. Yeah, it's working. Good. Took me a while to get this whole setup going again. Let's say you have VXUS. That's just the Vanguard Total International Stock. And whatever international fund you have, you can just put the ticker in and you can do the same thing that I'm going to walk through here. And this is all for free. I'm not signed in, I don't think. But in any event, this is all, you don't need a paid membership. So you go to portfolio. This is all in Morningstar.com. And then you scoot down to this area. This is sector, then you've got region, and then you go country. So, and it lists them in order based on the percentage of the fund, that's invested in each of these countries. And so we can flip through here. Am I missing Russia? I don't see it yet. Here we go. So if you own VXUS, you basically have nothing, as a practical matter, invested in companies, based in Russia, for whatever that's worth. But the thing is if you think about investors in Russia, they are predominantly, they have a huge home country bias in their investing, and that's not uncommon. Study after study shows that that's basically what we do, and we're no different here in the United States. And one argument, and I think this is a reasonable argument for just investing in U.S., let's say the S&P 500 or our total stock market, U.S. stock market fund, is that the companies, particularly in the S&P 500, they do business everywhere, right? Exxon, Microsoft, Apple, Tesla. And so then I get that argument. At the same time, when we look at things that happen in a specific country, in this case, Russia, and its economy is obviously night and day different than ours. Ours is far more diverse, far larger. On a total GDP basis, I think they're ranked 11th. we're of course one at the moment. On a per capita basis, we crush them. I think they're not even in the top 40 on a per capita basis, something like that. So the economies are totally different, but you do see how decisions that governments make have pretty significant effects on the people of that country and the companies, even companies in Russia that do business globally. Of course, they closed the stock market. I don't know if it's open yet or not, but where it's trading in some places, of course, the Russian companies sank significantly, and for obvious reasons because of the sanctions and everything going on, they're going to be in a lot of hurt for a while. And so, one can say, well, Rob, that's great, but I don't think the United States is going to invade Ukraine anytime soon, or to bring it home, I doubt we're going to invade Canada, which I think the last time we did that, I think was the War of 1812, right? Didn't we go into Canada? Anyway, yeah, we're probably not going to do that, you wouldn't think, anytime in the near future. But the reality is things can happen that we just can't predict. I mean, that's life, right? I mean, I don't know what is going to happen over the next 50 years. But I think it's unlikely that the U.S. will enjoy both the growth and dominance that it's enjoyed over the past, say, we'll call it 70 years, really, maybe since World War II, 70 plus. I'm not confident that the next 70, 75 years are going to look the same. Of course, I don't know, right? That's the whole point. We don't know. And so for me, I'm just more comfortable investing, at least to some extent, globally. Certainly, I do have a home-based bias. I have more in U.S.-based companies than I do international-based companies. But still, I've got about, I think it's 25% in international, developed, and emerging markets. And that's comfortable for me. Obviously, you guys, of course, make your own decisions, but that's sort of my thinking behind the whole thing. I also say, even in terms of, in some ways, it's hard to talk about what's going over there in terms of investing. It's like there's far more important things happening in terms of human life and the conflict than what a stock market is doing. I want to acknowledge that, but this show is not about that. It's about investing. And one of the questions I ask is, whatever's going on in the moment, however difficult it is, I kind of asked the same question with COVID when it first hit, although my answers there were a little less certain. But the question I ask is, will whatever's going on in terms of our investments, will it matter in 10 years? That's the question I ask. Now, of course, there's no way to know, right? But I mean, we just have to do our best. And I don't think this will matter in 10 years. Again, in terms of our investments, I think, boy, it's definitely going to matter, I think, globally. And just, I mean, if Russia just turned around and walked out, marched out of Ukraine today, just think about the investment and time needed to rebuild the country, let alone obviously the loss of life, which that's on a totally different scale. So yeah, that's my take on it. I really think international exposure is pretty important. Feel free to disagree. Put it in the comments. Tell me why I'm wrong. I get it. All right, I'm going to jump right into the questions. Yeah, remember, if you want to ask me something or have me cover a topic, please tag me. And I see a lot of questions, so we're going to dive right in. This one comes from Nicholas. Good morning. Why did you decide to invest in both big banks, Bank of America and Wells Fargo? Why not choose one big bank and perhaps a regional bank and or an investment house like Morgan Stanley or Schwab? So I decided to invest in two banks just for a little bit of diversity. I did it based on valuations at the time. Now I will say that 2 days ago, let's take a look at this on the screen. Is this right? Oh yeah. So let me show you this. This is ARC that I was looking at, but let's look at Wells Fargo. 2 days ago, it took a dive, and so did Bank of America. And actually, I think everything took a dive that day. So did Berkshire. And I added to all three of those. I bought a little bit of, it wasn't a lot, but a little bit of Wells Fargo, Bank of America, and Berkshire. And my approach is to generally invest in large, blue chip companies at a time. So part of it is a question of my perfect investment is in a company that I think its future is rock solid, but for some reason it's undervalued. It could be specific to the company, like Wells Fargo doing stupid things with customer accounts, right? Or it could be more sector-based, and that's true of both Wells Fargo and Bank of America. A year ago, just the banking sector generally was down. Or it could be the whole economy's down, a COVID crash, and so sort of everything gets kind of cheap. I don't really think about it in terms of buying the dip. So like 2 days ago when I bought, my thinking wasn't, oh, it's bottomed out, now it's going to go up. And in fact, it could very well go down. But just generally, is it at a reasonable price? And do I think 10, again, I always think in 10 years, do I think 10 years from now, I will be happy that I made this investment? And I think the answer is yes. Again, there's no guarantees in investments. I think Warren Buffett defines investing as something like having a reasonable basis that you can put your money to work and it will grow. The purchasing power of your money will grow, meaning after inflation, after factoring fees. So, that's kind of how I think about it. So I could dive into regional banks that would take a lot more time and research for me to do. And I just decide, and I could do that generally with small companies. And I generally just don't do that. So part of it's just time and comfort level. There's I'm trying to remember his name now. I can picture him. He writes for Seeking Alpha. What is his name? Hang on. He used to be a banker, and he does a lot of what's his name? I'll get it for you. Hang on. I like his writing. Oh yeah, Richard Parsons. Let me see if I can pull up his. I don't always agree with the way I don't always agree with his approach necessarily, but here he is. He does a lot on banking. He was a former banker and a really smart guy from what I can tell. And so I read a lot of his stuff, although I don't think I've ever made an investment based on anything he says specifically, but I like kind of the way he thinks through it. So anyway, Nicholas, that's my take on that. He, by the way, Nicholas also said, are you planning to make any changes to your 4-stock portfolio this year? I doubt it. I mean, if I can add to it, I'm happy to do that. Although even that, I don't think I'll add a lot, but I'm not at least at the moment. If we go into a big bear market and we're down 20 or 30%, then that's when I plan to start looking at maybe a fifth company. Nicholas also points out that the Washington Commanders, formerly the Washington football team, formerly the Washington Redskins, may move to Sterling, Virginia. And that's true, and I'm not at all happy about that. And I don't live in Sterling, but I'm just not sure of the benefit long term. And then you end up, 20 years from now or 30, whatever, we'll end up with a dead stadium that's just sitting there. Yeah. Anywho, okay. Arun says, hi, please provide guidance to set up bucket 2. So you asked me this last week, and I think I responded to it, but I don't understand what you mean for bucket 2. With retirement withdrawal using Vanguard or Fidelity funds. The bucket strategy is, and some people will use 2 buckets, but I don't think it makes sense. I mean, you can have your investments, let's say, whatever they are, and you can think of them as being in a bucket, and then maybe your checking account at a bank as your cash bucket, let's say, or, it could be a checking account at your broker, right? Even if you're at Schwab or Fidelity or whatever, they have banks too. So, but you've got this cash account for banking. And so if that's what you mean, to me, I wouldn't call that the bucket strategy. That's just, I don't know, how else do you do it? I mean, anyway, but the way I would do it, there's a couple of ways, but you would take money from your investments, let's say maybe once a year for your yearly spending, or I would probably do it quarterly. And you'd move it to checking. That's it. Now, the trick is, which investments do you pull from? And you've got questions about taxable accounts, before tax, traditional retirement accounts, Roth accounts. Generally, I would first move over anything that's going to be taxable, whether I spend it or not. So that would be dividends and interest from a taxable account. And if you're at the age, required minimum distributions from your traditional accounts, and spend those first. And then generally, if you need more money beyond either of those 2 things, of course, you may have other sources of income, right? Pension, Social Security. But if you need more from your investments, the general rule of thumb is sell taxable investments that will trigger capital gains. Hopefully it's long-term, and it'll only be on the portion of the sale that's a gain. And if you've exhausted that, then go to your traditional accounts, and then you do Roth at the end, because as we all know, we want our Roth accounts to get as fat as a tick. The only caveat I'll say is there could be exceptions to that. There could be years where for some reason you want to keep your taxable income lower. And so you don't want to pull, let's say, from a traditional, you want to pull from a Roth. Could have to do maybe with Social Security tax or IRMA premiums for Medicare, or maybe you're in the middle of doing some Roth conversions and that's got to get factored in. So these are all just sort of high level rules of thumb. Yeah. Andrew, good morning from California. Welcome. I love California. I could live there if the taxes weren't so. One of the best trips my wife and I ever took, we flew to San Francisco, drove up to wine country. We're not really into wine, but we enjoyed it for a day. And then just drove the coast all the way to San Diego. Beautiful, absolutely beautiful. Quincy, good morning. Okay. Andrew, he's taking the Series 65. That's the exam you take if you want to be a registered investment advisor. Any tips, material advice since you've taken it? Also, would like your thoughts on hourly based individual advising. Plan is to be an RIA part-time on my own. Well, in terms of taking it, the study materials I use, and I'll show them to you, just Kaplan. I used to work for Kaplan. I taught in law school. I taught the law school admissions test. I think I got like a top 95% when I took it. But after I taught it, I could get a perfect on it. So Kaplan does work. Back then, it's weird. I think the top score was a 48. If there are lawyers out there my age, you'll remember the weird scale for the law school, the LSAT, law school admissions test. I think the top score was a 48. I got a 42 when I took it, which I think was top 5% or 95th, whatever, however you'd look at it. But then after teaching it, I could get a 48. Anyway, I don't really know why I went into all of that. Kaplan Series 65. Let's see. Yeah, here it is. Let's see. Yeah, so this is what I used. I spent so much time because of my work studying things like asset allocation and all this stuff. There still were aspects of this that you needed to understand in terms of state and federal securities laws that you're going to get asked on the exam that I had to learn. But I wasn't too hard, I didn't think. In terms of being a registered investment advisor, sort of part-time, it's not easy. You've got insurance requirements. If you're at all online like I am, there are all these requirements on, keeping a history of all of your social media interaction. And, I really applaud those registered investment advisors that do this based on truly a fee only, not assets under management percentage. But it's tough business. I mean, the reality is getting million, 7-figure clients and charging them 1% is the way to make a lot of money, right? It's not something I would ever pay, and we talk about that on the show. But trying to make it work, based on some sort of hourly or fixed fee basis, it can be done, and they're out there. And we've talked about some of them. And if you're part-time, you don't have a lot of overhead, maybe you work out of your home, just be prepared for the regulatory requirements, which is probably why I never did anything with it. I thought about it and then decided, life is too short. But I don't say that to discourage you, although it probably sounds discouraging, and I'm sorry about that. Wasn't my intent. Okay. Greg says, thanks as always for the great content. Haven't watched Q&A from Monday, but hoping you blitzed the tournament and pulled out I don't know what that is. But in any event, I didn't. I mean, I played okay in the tournament. I played 6 rounds. 3 of the rounds were against masters, and I lost all 3 games, although 2 of them were pretty good games. One of them, I folded like a lawn chair. The other 3 games, I won 2 and drew 1. My rating stayed about the same. I think I lost a few points. It's in the low 1900s. Yeah. So Scott wants to know, why not take advantage of low-fee, actively managed mutual funds, which include both capital gains and dividends, in a tax-deferred account compared to similar index funds that only offer dividends? Well, The first question is, what do you mean by low fee actively managed? There aren't that many. And by low fee, probably the cheapest you're looking is mid 30 basis points, and that's rare, maybe a few Vanguard funds. But you're normally getting into the 60, 70 basis points. And there's no benefit to the capital gains. I mean, I understand in a tax deferred account, you don't pay taxes on it until down the road when you take the money out. But just like dividends, they're not making you wealthier. So I'm not sure what the benefit of looking for a fund that distributes capital gains. Yeah. I don't know why you'd do that. Now, again, in a tax deferred account, it won't hurt you. But I don't know why you'd actually look for that. Okay. I don't think I'm missing anything. I always think, what am I missing? That was the hard part about being a lawyer. It wasn't trying to deal with the tough legal questions. It was the worry that you aren't asking the right questions. That's the worry. So Andrew says, it looks like continuing with international might pay off for young investors, given it's likely to be down a bit longer. Feels like it has to jump up soon. Who knows? Not me. Yeah, I don't know either. I still think it's good for any investor. And I still view myself as a young investor. I know that's probably silly, but I mean, if I'm on this rock until I'm 90, I got some time ahead of me. If you think back and you think 40 years, let's say, what was going on 40 years ago? That was 82? What, Reagan was president? I mean, it's a long time. Okay. All right. So Ryan says, Ryan is from Haymarket, which is in Virginia, not too far. It's off 81. Haymarket, I drive through Haymarket very quickly, usually about 70, 75 miles an hour on Interstate 81. Anyway, wants to know, will you stay in Virginia for retirement or flee to somewhere else due to its cost of living? Right now, we're going to stay here. Where I live in Northern Virginia is very expensive, but once you've lived here long enough, you you absorb it, and it doesn't really affect us as much. Although real estate taxes, it does. VJ, where's VJ from? Let's see. Good morning, Rob and team from Ann Arbor. I keep expecting VJ to one day say, "Hey, good morning. I'm from Columbus, Ohio." I mean, here's the thing: unless he's being held captive in Ann Arbor, I'm not quite understanding why he's still there. Now, I will say, if he's a professor at the University of Michigan, okay, that would be probably a pretty sweet gig. But short of that, I don't know, VJ. Listen, if you're being held hostage, just let us know in the chat. We can call 911 for you. Okay. Anyway, what was the long-term implications of Russian sanctions on emerging and developing markets and any index funds excluding China and Russia? Well, I don't know what the long-term implications are, and in part because we don't know what the short-term implications are. I mean, is Putin going to stay in power for the foreseeable future? I mean, I don't think there's any way to know. I do think, at least what's coming out of the Russian government now, is they're not turning back. They're going to take over all of Ukraine if they can, and that's sort of their position. You would think, I mean, basically almost the entire world. There are some exceptions, but even China's now starting to show some lack of support in their way. The whole world is looking at Putin and basically saying, this ain't right. And so if he occupies Ukraine, I see sanctions staying until I don't know how long, for the foreseeable future. I mean, if it becomes an occupied country, I don't think we're going to lift sanctions. Now, what will be interesting is, at some point, a country and their financial interests begin to take over sort of the moral issues. Not right now, but how long can we keep that up? I don't know. But if he's, say, replaced in the foreseeable future, and things steps are taken to try to reverse what they've done and make things right as much as possible, then, the long-term implications will be very different than if Putin stays in power and this goes on for years. But having said that, as we looked at a minute ago, there's not a lot of Russian companies, and we just looked at one index fund. But I mean, if you look at their GDP, they're 11th in the world. A lot of that is energy. They're not making up a huge percentage, at least of the funds that I have and have looked at. Now, China, of course, is different. But are there index funds that exclude China and Russia? I don't know. Well, there obviously are, but I think are there funds that basically cover the whole international landscape except for those two countries? I don't know. You might Google it. Google it, VJ. Do they have Google in Michigan? Google it and let us know, along with whether you're being held captive. All right, Paul. Paul says, my 401k got liquidated after I sold. I guess he was a business owner. I need to put it in an IRA. Should I put it in IRA as 3-fund or look at all accounts and purchase funds based on balancing over all holdings? Well, so the way I do it is I look at all of our accounts, both all of my accounts, all of my wife's accounts, our taxable accounts, and do an overall asset allocation, so that if you were to look at any one of our accounts, it would look weird. I think I mentioned this last stream. You might see a traditional IRA that's got tips and emerging market. And it's like, what's going on here, Rob? But it's because it's part of an overall asset allocation. I don't think it's the only way to do it. And there could be situations where you might want to do it more on a per account basis, perhaps. Some have suggested you do it based on when you're going to use the money, and that could be very different from one account to the next. And there might be some argument there. In a way, even though I do asset allocation over all of our accounts, I kind of do look at that in terms of Roths, because I want stock index funds in the Roth accounts. Although in our case, the Roth accounts represent such a small percentage at the moment that it's kind of easy to do. If they represent more of your total allocation, that may be a challenge. But I do it over all of our investments. Part of it also could depend on how many different accounts you have. I mean, it might be easier for you to say, okay, I'm going to do a 3-fund portfolio, and I'll just do that in all of my accounts, and I'll treat them all separately, just because maybe it's easier for you to rebalance. The downside to doing it that way is asset location. Like I said, I want stock index funds in my Roths. I want bonds for the most part in a traditional. So if you just put a 3-fund portfolio in every type of account, you can't. It makes doing that asset location more difficult, if not impossible, I guess. So that's something to think about, I think. Mike, thanks for the like. And he's from Texas. I like Texas. So I want to go to a number of the football stadiums. SoFi would be top on my list. Beautiful stadium, but certainly Dallas is a big one. Maybe I could watch them lose to the Steelers. Well, probably won't happen. Historically, though, we've done pretty well. Okay. So Paul says, a few weeks ago, you said not liking locking in losses. Yeah, the concept. I put very large amount in taxable 1st of December. It's down. Why not sell, wait 30 days, repurchase? Well, my comments on locking in losses had nothing to do with tax loss harvesting. Some people are reluctant to sell something because it's below what they paid for it and they don't want to lock in their losses. And my only point was, you got to evaluate things the way they stand today, not where the price was a month ago or whatever. But from a tax loss harvesting perspective, that might be a very smart thing to do. Yeah. And, you could also, obviously you have to wait 30 days if you're going to put the money in the same or very, very similar investment, but you could also put it in a different investment right away if you wanted to, right? Go from S&P 500 to total stock market, for example, or wait 30 days. I prefer to, it's been a while since I've done tax loss harvesting, but I put it in different investments. Anyway, Mike, if building a taxable account from scratch, What funds would you personally choose for long-term total returns? Only planning for equity. And then keeping all bonds and tax deferred for now. Yeah, I mean, um, it would, I can tell you what I did. Not that this is the only way to do it, but I've got a total US stock market fund, VTSAX. It's a mutual fund. You could use VTI, an ETF. Then I have an international fund, so you could use VX US, for example. And then I have small cap. I think it was small cap value. I think it's just small cap now because some tax loss harvesting. I'd probably go with small cap value. But again, all of those were purchased in the context of all of our investments, making sure that the asset allocation across all of our accounts worked, was consistent with our plan. But that's what I used. So, yeah, that's how I think about it. I wouldn't, obviously, you don't want to put REITs in there. So, Scott says, what is lost when struggling fund managers prognosticate future positive earnings in a few years? Are the average investors who cannot afford to sustain the pain for that period of time? Well, I'm going to push back on that. If an investor can't withstand a few years of bad returns, why are they in the stock market or that fund to begin with? Right? And that would be true of even of index funds, right? If you can't handle, for whatever reason, there may be good reasons why you can't sustain 20% drops for the next 3 years, because maybe you need to spend the money. Then the question, though, is why are you in that fund to begin with? If it's just psychological, you don't need the money, but you're scared to death, then, and I get it, but then you need to figure out how to overcome that fear, which, I know you're, Rob, look, you're some Yahoo with a goofy picture behind you in front of a mic saying, well, just get over it. Yeah, I don't mean to suggest it's easy. And we've talked a lot about different ways to do it. Experience, understanding the history of the stock market, why it goes up, why it goes down, keeping your debt low, having a good savings rate. But you really need to, doesn't mean you have to be 100% stocks, but if you're coming in and you're 25% stocks and 75% bonds and you're a long-term investor and it's because you're scared of the stock market, the problem is, yes, you're going to avoid a lot of the volatility, but you're going to do so at the cost of expected returns. And you're going to, in a way, you're going to bring about the very thing you fear. The thing you really fear is not having money, right? Or not having enough money. And your fear of volatility, if you let it completely control your asset allocation like that, is going to bring about the very outcome, that you were afraid of. In some ways, by the way, Putin may have done the same thing. He's purportedly afraid of expansion of NATO. And that's what, in theory, prompted him, among other things, to do what he did. And in doing so, he could bring about the very thing he was afraid of. I don't know. What credibility should we give a world leader that rides on horseback without a shirt on? But then again, glass houses, I don't know. We've had our share of interesting leaders, and I'm not going to name any names. This is not a political show. Okay. Branding says, hi, can I use capital losses in a taxable account to offset Roth conversion taxes? That's an interesting question. I don't think so. Well, let me tell you what I think. People in the chat can tell me if I'm totally wrong. I'm not a tax expert. So when you have losses, you can use them to offset gains, right? We know that. That's easy. And then if you've wiped out all your gains for the year and you still have losses, you can offset up to $3,000 in income. Beyond that, you can't use them anymore. They carry over to the next year. So a Roth conversion is going to be income. It's not going to be taxed as capital gains. So apart from that $3,000, I don't believe you can. And I am happy for someone smarter than I am, particularly about taxes, to tell me in the chat that I'm wrong. But G branding, that's my belief. Ram, Ram gave me 2 thumbs up. So for all of you that just gave me 1, he really outdid you. Although LT gave me a face, an okay, and a thumbs up. So I don't know, Ram. Maybe LT outdid you, but appreciate it. Okay. Okay. Lime nuts. I don't know if I should be saying that out loud. We are cash heavy. Now, I think that means they've got a lot of cash, or maybe it's on their person and they're struggling to move. I don't know, but they're cash heavy. I know that. Does it make sense to have, and by the way, this is just tea. There's nothing saucy in this. Does it make sense to have investment accounts be all equities, but be a bit cash heavy? Well, there's an argument for that, right? I mean, if you think about the Warren Buffett portfolio, it's 90% S&P 500 and then 10% short-term treasuries, which is effectively cash. I mean, it's technically a U.S. government bill. That's how, if we think about like a Berkshire Hathaway, they got 144 billion. They can't very well log into ally.com and move 144 billion into an online savings account, right? So they treasury bills. That's where they put their cash. So if you got a very, very short-term treasury fund, under a year, that's a practical matter. I guess you call it cash equivalent. So, certainly one could make the argument that that's a reasonable approach. You notice, by the way, 10-year Treasury was above 2%. And of course, after the war started, people are flocking to government bonds, particularly U.S. government bonds, for safety. And now the yield is, what's the yield? 185? 183. And so, when it was going up to 2, we were all like, why bonds? Get out of bonds. Rates are going up. And then, of course, it falls. So that's a pretty significant drop, by the way. And it was even lower. It was down to 170 just a couple days ago. This is where I'm looking, by the way. CNBC. Of course, long term, I still expect rates to go up. So, but it just shows you how unpredictable all this is. All right. James wants to know if I always thought of all of my investments as one portfolio, or did you ever think about asset allocation in each separate account? Trying to transition my thinking to the all as one approach. I may have early on. You think about it, you're starting out, what do you do? Well, you open up a 401k at work, or you open up an IRA. And that's, if you're like me anyway, that's all you had. So you've got one account, and then, eventually maybe you have a second account, maybe you do a taxable. And I was early on, I was probably thinking about it and account by account. But then what happens is, if you think about it, particularly if you're married, so you could have two 401ks if you're both working, 2 Roths, you might have 2 rollovers, or you might have 2 rollovers and 2 traditionals potentially. You could have 2 HSAs and then a joint taxable account. And I don't have enough fingers now. I'm short a finger. It's 11 accounts. Now maybe that's extreme, but you could easily have a half a dozen, and it gets challenging to do it one account at a time, in my view. It could be done for sure. And, if I were going to do it, one of the things I might do, particularly for smaller accounts, is take a small account, let's say it's an HSA or whatever, maybe a traditional rollover, but it's got, relative to all of your assets, a small amount, just throw it in a target date fund and then not worry about it, right? And then you don't ever have to, at least for a long time, deal with it. But yeah, I think once we started to have more accounts, it became it just became easier. And then again, you've got the asset location benefit that gives you. All right. So LT, 2 years of our expenses are in cash at Discover Bank, I think, earning 50 basis points, which is pretty good. I think the highest, Axos Bank is still 61 bips. At least I checked it about a week ago. But 50 basis points, it's competitive. The rest is in 60% VTI and 40% SCHD. That's Schwab's dividend fund. Collecting the dividends and withdrawing approximately 3% of VTI. Thoughts? Well, so I'm guessing you're in retirement, but that may not be right, but you're withdrawing money. So I'm going to guess you're in retirement. So for me personally, that would be too rich in stocks because you've only got 2% or 2 years of expenses in cash. So that would be too rich for me unless I'm misunderstanding the numbers. And I personally, again, would prefer some international exposure, maybe some small cap, because SCHD, we can look at it again. We've looked at it before, but it's a large cap. It's a good fund. I like it. But it's a large cap fund. We'll pull it up here. So if we go to portfolio, I don't know why it's not showing up. That's kind of weird, but it's a large cap fund. What's going on with Morningstar? Where's my blue dot? An outrage. Anyway, you can actually, the other way, by the way, you can see this is to go to market cap down here, and you can see 78 billion, which is a pretty good size. If we were to go, let's go to, what was your other fund? VTI, right? Yeah, let's go to VTI and see. So what was that? 78 billion, something like that? This is going to be more, I think. Could be wrong. First of all, let's see if we get our blue dot back. Whew, it's a close one. All right. Yeah, this is bigger, but still 78 billion is going to be, it's going to be somewhere in here. So, it adds a little bit of diversity because it's a value. SCHD is a value fund. I know people think of it as a dividend fund. I think of it as a value fund, and dividends is just a byproduct, which may or may not be a good thing depending on where you hold it. So that's my take, LT. But again, I don't know a thing about your situation. So, all right. Andrew says, like the new digs, could use a touch more light on the back. Yeah, maybe if I put a light behind me. See, the deal is I can increase the light. Like I can wash myself completely out, right? Or maybe you guys prefer this. I look pretty good like that. So, I'm not quite sure where to put it. That's where it is now. But yeah, I do need some more light. I'll work on it. Gage says he's reading Guy Spears' Education of a Value Investor. So I interviewed Guy on the Dough Roller Money podcast. I don't do the Dough Roller Money podcast anymore. There's more coming out that I did do that are being released, but I'm not doing anymore, or maybe one or two. But if you Google here, I'll pull it up for you. It's a good interview. I had a lot of fun. He's a great guy. He runs a fund, Aquamarine. I think it's Aquamarine. And he was one of the guys that bought lunch with Warren Buffett. So here it is on Dough Roller. This is not my site anymore, but wow, has it been that long? Wow, 2017. It's a long interview. Where do we actually listen to it? I don't know how their site works anymore. Like, is there in the event, you can figure it out. I want to listen to it. Like I would expect to play. Oh, there it goes. No, maybe not. I don't know. In any event, it's probably, I don't remember what we talked about. I remember it was a lot of fun. His book, by the way, Value of, Education. I like the book a lot. I will say, and here it is, just on Amazon. You can check it out. This is not the kind of book you want to read if you're trying to just sort of understand asset allocation and investing in your 401k or IRA. This would be more if you want to invest in individual stocks, right? But in the event, I should finish this question. I'm pretty sure you spoke with him in the past. What is the biggest takeaway from your meeting with Guy? So I don't remember a lot of the interview because it was 5 years ago. The one discussion that I remember, though, or one aspect, apart from the fact that I was fighting a cold, and in the middle of the interview, we were, there was video. I took a big swig of water, right? And then had this cough reflex and spit the water out all over my computer screen. You probably didn't really care about that. He talked about his views on Amazon and how he viewed it. I think this is what he said, if I'm remembering it correctly, that it was a value stock. And I just couldn't understand that because its PE was in the stratosphere. But certainly from a performance perspective, it proves that Guy Spear knows a lot more than I do, because can you imagine, I mean, even since 2017, what has Amazon done since 2017? Let's see here. I'll pull it up for you. Here it is. And we're going to go 5 years out. Yeah. So it was trading at 850 and now it's at 3,000. That's okay. You do the math on that. I'm not sure that that's like, I don't know what the compound annual growth rate is on that, but it actually doesn't strike me as outrageous compared to the market, but maybe it was. In any event, that's what I remember from the interview. And I was trying to wrap my mind around how he would think through that. Great guy. I get a Christmas card from him, or holiday card from him every year. And the one he sent out this year was great. It's almost hard to describe. In any event, it was, yeah. Kelly, good morning. How would you downsize a taxable account portfolio with 8 index funds? Well, you got to deal with taxes, so you got to factor that in, but let's ignore taxes. It depends what your goals are and how much you want to simplify it and what those 8 funds are. I mean, to me, the starting point is a 3-fund portfolio. So it's a total US stock market fund, total international, and a bond fund. And then I think the burden of proof, so to speak, go back to my lawyer days, would be on adding any other funds. Can you articulate a reason that you want to add a fund, an asset class beyond the 3-fund portfolio? That's how I think about it. And I do. I like the diversity of small cap and REITs and emerging markets. And in the case on the bond side, of some tips. So I have my reasons for doing that. But you would need to articulate for yourself what those are. And I would put the burden of proof on, it's kind of like the fund comes to you and says, I want to be part of your portfolio. Really? Well, I've got a 3-fund portfolio. Why do you think you could help me if I added you to my portfolio? And interrogate the fund or the asset class. I know, it's kind of weird, really, now that I think about what I just said, but that's how I think about it. I don't actually talk to my mutual funds, though, just to be clear. Finway says, is the war in Ukraine and uncertainty in Europe just another reason why VXUS will not outperform the US funds? At the end of the day, are we too optimistic about foreign investments? Actually, one could argue that that might be a reason why it does outperform in the long term, right? I mean, who knows? That's the thing. We think we can predict all of this and we can't. What happens if Putin's gone and the world pressure on Russia doesn't change the country overnight, but results in progress towards a country that's, behaves itself? I don't know. Think of also Germany's change here now as part of all of this. And maybe it brings European Union, it bolsters, their unity as a war can often do. So I don't know that, my takeaway is I have no idea how this war will affect, the world, of course, but then investing over long periods of time, other than I think generally, as I said, 10 years from now, I don't think the story, when we look back 10 years from now, I don't think the story of the decade will be that the international investing was influenced completely or, in large part by what's happening right now in Ukraine. But if I'm still doing this show 10 years from now, VJ from Ann Arbor can remind me of what I said, and maybe I'm wrong. Nick says, I like Paul Merriman and his teachings and was wondering what allocation did you keep as small cap value in your portfolio, or what would you recommend? I've just always used, well, not always, but for a long time, just the Vanguard small cap value. DFA has some interesting small cap value. But if you go to, I'll pull it up for you, Vanguard small cap value. Here it is. This is their ETF. This is what I've owned, VBR. I've owned the Admiral shares, which is VSIAX. You know, I'm not here to say it's the best or the one you should own. DFA, Dimensional Fund Advisors, it does a lot with value. I don't think they have an ETF version of their small cap value, but I could be wrong. And the reason that's important is that I think you can only buy their mutual funds through an advisor. You can buy their ETFs on your own, and here's their small cap value. But it's a mutual fund. I don't think you can buy this on your own. I could be wrong. But anyway, yeah, I've just used Vanguards. At one point I used, is it Bridgeway? Bridgeway has a micro cap fund. Bridgeway micro cap. Ultra small, that's what they call it. So not just small, ultra small. I invested in this years ago. And my thinking back then was, well, if small cap is better, I bet ultra small cap has to really be better. And it could be a great fund. I haven't looked at it in any detail in a long time, but yeah, for as long as I can remember, it's just been Vanguard. Nicholas doesn't like my water bottle being here. I'm happy to move it. I'll put it on the floor. It's good to know. See, I don't know what's distracting, and I got a lot more going on. And I'm further from the camera. All right. Matthew, what is your idea on the idea of backing into your fund number that's discussed by the retirement and IRA ratio, meaning you calculate needs and the rest can be spent at any time? I'm not sure I follow that, to be honest with you. Maybe I do. When I think about retirement spending, and I think new retirement can work this way as well. But I think about what do I need to survive? And when I think about that, I don't literally go to the bare bones, sleeping in a tent under the highway. But, with our current lifestyle, but not doing any exotic traveling, not, remodeling the home, sort of a basic lifestyle. What do I need? And then, okay, if things go well, how about some, as you call it, fun money? And when I was doing the work with Schwab and they were using Money Guide Pro, that's exactly how they set it up. And I think there's some benefit to doing that. You just have to be realistic with the numbers, because you can in two ways. You can cut the necessities, I think, too much to a point where if you really had to live like that for a long period of time, you would be fundamentally unhappy. Although I do think we tend to adjust. But the other mistake we can make is we can have, maybe it's just the other side of the same coin, but if we have this fun money over here, how important is that really? I mean, we can sit back from a planning perspective and say, well, if I don't ever travel, that's not the end of the world. But then 4 years later, when you haven't gone on a trip and you really want to, but you've quit your job and you're sort of locked in now to this certain retirement spending. So you've got to be really, I think, realistic about the numbers. I wonder if I can quickly pull up new retirement. And let me just see if I'm in the right one. Yeah. So this is the demo account that I've shown you guys before. And you can, if you go to, let's see, I guess it's just expenses. So this allows you to look at different things. So you can have reoccurring expenses, right? And you can add one time. So that might be one way to think about fun money, potentially. But even within reoccurring, you can add different kinds of expenses. But I like the one-time expense. Like if you want to go on a trip or you want to remodel your home, because you can put in there the specific year and model those different things. I'm wondering though if you can, and then I think you can run different plans with different expenses. So if we go to overview, I know you can do alternative plans. Maybe it's a what if scenario. Yeah, so you can run what if scenarios. And I've not actually done this, but you can run what if scenarios, model retirement spending stages. And so there's a lot of, the point is, there's a lot of functionality in there that I haven't even used, Matthew, where you could model a lot of that. Gage, what is your favorite valuation method for individual stocks, or do you use different ones depending on the industry? That's actually true. I use different ones depending on the industry. It's like with a bank, book value is really important. With Apple, I don't think book value would be as important. I mean, sometimes book value is also tricky because there could be things like, maybe they own a lot of real estate, but it's not on their books at present value. It's the lower of their cost or current value. So often it's at cost, but yeah, so it depends on the industry. But I don't have any special magic formula. I look at price to sales, I do look at price to book depending on the industry, PE. One of the things I look to is profit margins. What are their margins, both gross and net? How does that compare to others in their industry? And if it's higher, why is it higher? You may not come up with an answer that you're positive of, but I try to answer that question because I want to know, is it durable? Is it going to stay that way? And then what do they do with their cash? How do they reinvest it back into the company? Are there opportunities to reinvest it? Right? So people look at dividends, like they look at AT&T and say, look at that 8% dividend. And I think, well, why aren't they reinvesting that back into the company? Are there no opportunities for reinvestment at AT&T, or are they very limited? These are just questions. I haven't answered them for AT&T, but that's how I think about it. But again, that's one of the reasons I've only got 4 companies in our individual stock portfolio. It's a lot to keep track of all that stuff and to evaluate it. And I think some investors just get too trigger happy, and before you know it, you got 24 stocks in your M1 account. And to me, that's just not. You might as well just buy the S&P 500. Well, so Joshua asked the question: if you were just going to invest in 3 funds while in retirement to provide income, what would you suggest and how allocated? Well, so this is going to sound a little unusual, but I don't think about investing for income. And I know in retirement that becomes very popular because we need to take money out and spend it. But when you talk about stocks and income, you're talking about dividends. And dividends don't make you wealthier, right? And if you want to understand my thinking on that, you can search in the channel for my videos on dividends. I'm going to, dividends, depending on what type of account, are going to get reinvested. They're going to get reinvested one way or another, whether it's automatic or not. Or in the case of a taxable account, when I'm taking money out, I will just spend the dividends because they're going to get taxed anyway. But I'll just take money out and rebalance every year. When you look at all of the literature on safe withdrawal rates, whether you go back to Bengen's in 94 or, Kitces or Guyton Klinger or Wade Pfau, they're looking at overall total return investing, taking money out each year and rebalancing. They're not looking to invest for income. So I don't think of it that way. I don't think about trying to find an investment that pays, say, a higher dividend yield than the average, which now is what, 1.2% roughly, I guess, for the S&P or something like that. I just don't think of it that way, Joshua. Alexander, thoughts on Powell's testimony yesterday? Summary: inflation will subside on own due to supply chain improving this year. Only 25 basis points increase this month. War impact too early to tell. Well, I generally agree. Not that here's his level of understanding when it comes to economics, and mine's somewhere down here. I think I agree with everything there except the supply chain issue comment. I am less confident that solving the supply chain will solve all of the inflation problems, and we'll go back down to sub 2%. And maybe he doesn't believe we'll go down sub 2%. why are wages going up, for example? Because of the supply chain? I mean, why are we having a hard time filling jobs? Because of the supply chain? Maybe. I don't know. It doesn't make sense to me. I think there are reasons for it. I think fiscal and monetary. The one thing that our government, at least the leadership in our government, won't do is say that fiscal and monetary policy are part of the problem, because they're the ones now. A lot of it was in the prior administration too, but today it's the current administration, and they drive the fiscal policy, at least to the extent they can. Obviously, the Build Back Better plan didn't go anywhere, but they did a huge stimulus before that, and so that's going to take a while to work through the system. And to me, that's a big part of the inflation picture. But you don't hear that talked about. It wasn't in the State of the Union address, and of course, maybe I'm wrong. Maybe the fiscal spending. Maybe we can spend almost indefinitely without triggering inflation. It almost seems like we can, or at least it did until recently. I'm just not a big believer in that. I don't think we can do that. So, but the 25 basis points is what it is. That's what everyone expects now. And yeah, I don't think we have any idea how the war will impact inflation at this point. It's clearly increased energy prices. All right. Sure. So Jersey Boy, can you explain pro rata rule? I have a rollover, traditional and Roth IRAs at Vanguard. I have 60,000 in a rollover IRA. I do backdoor Roth 6,000. However, can I avoid pro rata rule backdoor Roth? So again, my understanding, I'm not a tax professional, but if you have, so when you do a conversion, a Roth conversion, whether it's a backdoor, that's just our term, right? That's not an IRS term. What you can't do is say, all right, I've got this $6,000 over in this IRA account. I've got more over here, but I'm going to ignore that. Pay that? No, never mind. I'm only going to convert this 6,000, and there's no deduction on this, and I just put it in there so I can convert it and not pay taxes. The IRS says no. We have to look at all of your IRAs, your traditional IRAs, and if some are pre-tax and some aren't, we'll take the ratio of those and we'll apply that to your conversion. So let's just say it's 60% is pre-tax. You got a tax deduction because it's a rollover. Then 60% of your conversion will be taxable. That's my understanding. People smarter in the chat than I can say, Rob, you got it all wrong. That's okay. All right. How are we doing on time? Oh, we're doing fine. Bob wants to know my thoughts on how to allocate between VOHIX, no idea what that is, but we'll look at it. BIV, I think I know that one, versus AGG, and I think I know that one, for my bond non-tips portfolio in a taxable account. I live in Ohio. Well, you're just good people right there. And fall in the 24% federal tax bracket. Well, let's take a look at these funds. So I don't know. VOHIX. That just Vanguard. Oh, I didn't know they had an Ohio long-term tax exempt fund. It's long-term. That's scary. What's its duration? Oh, only 5 years. I wonder why they call that long-term. I don't know. Maybe in the muni world, that's long-term. That seems kind of odd to me. But in any event, so that's a tax exempt, right? So you're not paying. Well, I don't think you'd be paying. You might not be paying state or federal, right? Because it's an Ohio fund, but you would know better than I. So that's one fund. Fine. BIV, we've looked at this fund before, and it's just a Vanguard intermediate term bond fund, and the portfolio is a mix, you can see, of government and corporate. The one way it's different than the BND, which we've looked at, is there's no securitized, or none to speak of. and it's an intermediate term. And then your last one was AGG, which is it's their income fund, right? Or aggregate bond fund. So this would be like a BND, I'm pretty sure. We'll look at the portfolio. It should have some securitized. Yeah, right here. So if you think about this for a moment, BIV and AGG have a fair amount of overlap, right? And we can look at that. I'll pull up the site. Here it is. At least I think they do. Maybe I'm wrong. Now, again, AGG has like mortgage-backed securities. I'm assuming is what that is. Zero? Come on. How's that possible? No overlap. Really? I find that hard to believe. They got 40% U.S. government. Intermediate term, I just find that hard to believe. But in any event, that's what it says. So, in a taxable account, in theory, so this is where I like to allocate across all my accounts. So in a perfect world, I would say, well, look, from a tax perspective, let's put it all in the Ohio tax exempt fund. The problem with that is, and I don't know what percentage of your overall portfolio this is, but that may be far too much exposure to a fairly limited asset class, right? Municipal bonds in Ohio. I mean, I love Ohio, but still, right? But if you didn't have as much there and you could put the other bonds in a tax deferred account, that would be ideal. Now, maybe you can't do that. Again, I don't know how much money we're talking about. In terms of diversification, there's certainly diversification between the Ohio fund and the other two. I would think that between BIV and AGG, and maybe I'm just missing something, which can happen, that there's a lot of overlap other than the mortgage-backed securities. And so in my mind, I'd probably just pick one, and I'd probably pick AGG just to simplify things. But yeah, so those are my thoughts. But it all revolves around the tax issues, and can you get as much of the bonds out of a taxable account? Again, the yields aren't particularly high right now, so it's not as if they're throwing off a ton of income. So maybe it's not an issue for you. But even at 24%, and that's the federal bracket, you've got Ohio taxes, right? Although I guess there might not be much. Well, it depends on the bonds held in those funds. I don't know how much in Ohio taxes you would pay. So again, you'd have to look at that. But personally, I like to keep things as simple as possible. So my question to you is, why own BIV and AGG? It's a question. Maybe you've got a good reason to. As I said, maybe I'm missing something on the two funds that I'm just not seeing, and they really are very different. But those would be, I guess, that's not so much an answer, Bob, but some of the questions I would be asking. And I'm sure there are other good questions that I'm missing. So Dan wants to know my thoughts on investing in international bonds. I had a lunch with a good friend, and I've actually alluded to him in the past. He's got this massive spreadsheet where he was investing in country-specific funds to try to mirror the entire world equity markets. And we had lunch for the first time since before COVID, actually. Just yesterday down at Union Station in DC, and that place is deserted. I bet the folks there 10% of what would have been there pre-COVID. I mean, half the shops are closed. Sad. In any event, I asked him about his spreadsheet. He still has the spreadsheet, but he said he's greatly simplified his portfolio. But one of the things he said was he's moved into a bond portfolio that's got a lot of international bonds, and actually, I'll show you the fund he mentioned to me, which I haven't looked up. Here it is. Yeah, the Global Bond Fund by Dodge and Cox. Here it is. Let me see if I can make it a little bigger. Does it tell us the ticker? Let me look at it in Morningstar. Maybe. Oh yeah, DODLX. Here it is in Morningstar. One of his comments, and I don't disagree with this, by the way, the expense ratio is pretty high, 45 basis points, but he was saying that he thinks, and I think he's a big indexer, but he thinks that there's an argument for actively managed fixed income outperforming index funds. And I've heard that argument before, and I can't necessarily disagree with it. Depends what data you look at. But this is, if you look at the portfolio, I'm pretty sure it's international. Well, obviously it is. It says global. And I guess will this tell us? Will it tell us? I don't know that it tells us. I was looking at if it told us geographic. It might somewhere. Well, you can see some of them here, but in any event, this was his fund. I've personally never, or at least not that I can recall, invested in an international bond fund. Given the purpose of why I invest in bonds to begin with, stability in the portfolio, some income, security, I've just never felt a need to go to international bonds. I don't think it's a mistake. And actually, I'll spend a little more time looking at this fund that my friend mentioned that I just showed you. Not that I suspect I won't invest in it, but not because I think it's a bad fund or a bad idea. I just have never felt a real need to go to international bonds. Russ says, if I held Vanguard funds at Fidelity and Fidelity went out of business, would I lose the Vanguard funds? No, that's, again, this is my opinion, but no. I mean, when you have securities at a place like Fidelity, right? It's not like they can take your securities and sell them and pay off their creditors, or that if they went bankrupt, their creditors could go after your investments. It doesn't work that way. So, we're not talking about like fraud or something like that. But I don't believe you would. That's my opinion. I'm not worried about it. Maybe I should be. I don't know. Thomas asks a very important question. What would you do if you won the lottery of $50 million? Well, I wouldn't be on the YouTube channel Thursday morning. I probably would be. I'd probably be right here streaming. And I probably wouldn't tell you that I won 50 million. Sorry. I honestly, I don't know that I'd do much different. I'd invest most of it in index funds. I'd put some more amount in individual stocks. Still wouldn't own a lot of companies. The thing is like, would you go out and buy a second home? Maybe. Would we be happier? No. I wouldn't change a whole lot, I don't think. I'd still be mediocre at chess. I really wouldn't do much different, I don't think. Maybe I'm kidding myself. I don't know. Saeed, if I'm pronouncing it right, what do you think of Robo Advisors? I think they're great. When I set up young people with an investment account, I talk to them about the pros and cons. Invariably, they choose Betterment. And I think Betterment's a great service. We can look at it on the screen. You do pay 25 basis points on top of the cost of the ETFs. So there's a fee. But here it is. They do the rebalancing for you. If it's a taxable account, they do tax loss harvesting. They have, when you sign up, they walk through screens that help you figure out what your asset allocation should be. And they take care of it from there. It's not the only option. Wealthfront, I think, is a really good option as well. Probably the two that I focused on the most. There are some, like Schwab has intelligent portfolios, which is free, but they require you to keep, I think it's at least 6% in cash. I think that's the number. I could be wrong. And that's how they make their money. So there really is a fee. I mean, why do you want to give someone, I just think they should just charge a fee, and then it's more transparent. I know SoFi has one that I've not really looked at. I have on my long to-do list to do sort of a best of Robo Advisor kind of article. Maybe I'll do a video with it and give you my thoughts. Here's SoFi's. Well, this is their bank. By the way, there are some accounts out there, including SoFi, that are offering 1% APY. So in some ways, there's some checking account options. You got to make sure you read all the details. That here's their investing that can pay 1%. So M1 Finance is another one that does. So I plan a video on that too, by the way, because I know, big issue is how do we get as much yield as we can. And so, John wants to know, when you talk about having 25% invested internationally, is that 25% of equities or 25% of the total portfolio? It's of the total portfolio. And I think it's 15% sort of total market and 10% emerging market. I'm not wedded to that. I mean, at some point you just have to make a decision, right? And so that's kind of where I've been for a long time. Yeah. The emerging markets are interesting. I mean, it is like the Wild West. I mean, look at Russia, emerging market. You wonder why. I mean, I just don't get it. You see the pictures of him like at this long table? He's at one end and he's got like two, I guess, generals. Like they're like a mile and a half down the road. I mean, it's probably a 50-foot table. Maybe I can pull it up. My friend I had lunch with, his theory was, some would say, well, it's COVID, social distancing. Yeah, 50 feet. But let me see if I can find this picture of Putin. Let me spell his name right. At long table. Oh, here it is. See how big I can. Well, I'll just show it to you here. I don't think I can make it any bigger. Maybe I can. No. All right. Here it is. This right here. And all I could think about is, it's got this middle section right here that's raised, but if it didn't have that, wouldn't that be a cool table to play paper football on? And I hope some of you know what that is. I mean, can you imagine the field goal? That would be impressive. Anyway, his theory was that he's actually afraid of assassination attempts. I don't know. I don't even know how I got onto that. Okay. Vinyl says that in 1982, I remember I made a reference to 1982, the Dow was under 1,000 and Culture Club was on the radio. Man, I feel old. So he says, what is a good, moderate, decent return on investment? Well, that's an interesting question. I was reading this article that I actually meant to show you at the start of the show and forgot. Here it is. The Case for Global Investing. So if you just Google that, this is Meb Faber. And he talks a lot. What he does is goes through 6 sources that talk about, in his view, why you should have international investments. But one of the things he talks about is his rule. He calls it the 5-2-1 rule. That says historically, stocks have returned 5% on an after inflation. So these are all after inflation numbers. Stocks 5%. Let me make sure I get this right. Bonds, I think 2%, and I guess 1% was cash. And so, here it is. Yeah, 5-2-1. Right here. He talks about it in there on an after inflation basis. And by cash, he means, like you can see here, bills, meaning U.S. government bills, which are bonds that mature in under a year. By the way, interesting charts throughout this article that I encourage you to read if this is of interest to you. But I found this interesting. So this is 1900 compared to 2019. The United States, look at more than half was all railroad, right? So how much it's changed. But the other thing that was even, I thought, really interesting, relative size of world stock markets. 1899 versus 2019. You see here, we were 15%. Now we're 53. I think it's higher than that now. But is that, why do we think that this is going to look like this 50 or 100 years from now? It's probably not. Anyway. So Don wants me to look at FBGRX. Whoops. FBGRX. Fidelity Blue Chip Growth. Here it is. So it's expensive. That's the first thing I notice. 79 basis points. So that tells us Well, it tells us it's probably an actively managed fund. Believe it or not, there's some like S&P 500 index funds that are outrageously expensive, but I'm going to guess this is an actively managed fund. It's got a fair amount of turnover. So if we go to performance and we look at distributions, let's see. So it distributed quite a lot in capital gains. Now its NAV at the end of last year was 177. So, but it's approaching 10%. So, not a fund I would personally want to hold in a taxable account, right? And if we look at the portfolio, it's going to be large growth. Just we know that from the name, but we can see it here. And if we look at its companies, I mean, it starts off basically like not unlike an S&P 500. I mean, not all the way down here, but just the top 5 companies. I don't know where NVIDIA is. It wouldn't be number 5 in the S&P, but at least I don't think. But you're talking 30% or more. So it's a pretty highly concentrated fund. Of course, the S&P 500 is as well. The question I would have in looking at this is if we compared this to, let's compare it to VUG, which is Vanguard's growth fund. And I'll show that to you. Here it is. We'll go to portfolio. So same kind of fund. So you notice I'm looking at, we go back up here. I mean, the blue dot doesn't tell you necessarily that they're identical or anything, but I mean, they're both investing in the same asset class, US large cap growth, right? And if we go then back to Vanguard's fund, we can go and look at the top 10 and, a lot of similarities. They're not in the exact order or the exact percentages, but Applesoft, Microsoft, Amazon, here's NVIDIA, Meta, which I still can't get you to that name. And then the other thing we can do, if we want to just kind of look at historical performance, is go to Portfolio Visualizer. Here it is. We'll back test a portfolio. So we'll pick, I don't know how much data it has on VUG, but we'll find out. Oops. And then we'll look at your fund. Again, FBGRX, right? Yeah. Now, these results, and I have no idea how they've done. So look, they've actually outperformed quite a lot, actually. These are after fee. So that 79 basis points that we saw for this fund, right, is factored into these returns. They were neck and neck, boy, for a really long time. And then about 5 years ago, Fidelity Blue Chip certainly took off. So, I mean, the question is, how confident are we that it'll continue to outperform? What happens if it starts to underperform? Will you stick with it? That's the hard part about an actively managed fund. It may be great over the next 30 years, but to get to that point, you may have to underperform and live with significant underperformance compared to an index fund for quite some time. And then if we look at, the other thing I like to look at is year by year. So what does this tell you when you look at this? When you look at these numbers, anything stand out to you? Certainly there have been some years where one has done better than the other. It looks like there are more years, of course, that Fidelity has outperformed, but this really stands out to me. And you wonder what the relative performance would be without 2020. And the reason I ask that question is because if a fund's outperformance, say of an index, is attributed in whole or at least in a large part to one pretty significant year, and they certainly outperformed. We'll hear Vanguard outperformed, but they outperformed in other years, but not like this year. How confident are we that over the next, say, 20 years, Fidelity is going to outperform again? Because if they didn't, their performance would probably be more comparable. So it's just something to think about. I do have a bias towards index funds, as you all well know. And then you can look at rolling averages for what that's worth. Now we could also compare this to like a QQQ, but to me a QQQ is a little more of a specific fund. If you come back here, Fidelity's fund has, let's see, 350 holdings roughly. Vanguard has 267. But if we go to QQQ, as we probably already know, it's not going to have as many, right? Go to portfolio, scroll down. It's got 100 roughly. So in some ways, I think VUG is probably a better comparison to Fidelity Blue Chip. Maybe, by the way, maybe not the best comparison. We could look at maybe at others, but probably a better comparison than QQQ. And QQQ has outperformed. But again, it's largely a tech. I mean, a lot of growth, it comes from tech, but it's largely a tech company. And in fact, the way you could compare that, if you wanted to, is in industries. So this is the Fidelity Fund. And if we go to technology, it's 41%, right? If we go to QQQ, it's not a huge difference, but it's a difference. It's 50%, 49%. So you can look at sectors that way and see how they compare. Anyway, I mean, the long and short of it is Fidelity Fund seems to have done well. It's a growth fund, which would scare me a little bit right now because of valuations. All of the funds that we're looking at would give me pause because of valuations. I just wanted to see how much technology is in VUG. Yeah, it's closer to the Fidelity Fund. So those are my thoughts. I think it's a good fund. You know, it could be in for some rough ride, a rough road ahead if, particularly if interest rates do rise up, because I think it's going to hurt growth more than it hurts value, would be my best guess. Okay. Bradley, if looking to tilt toward value and Roth is part of the picture, would you consider SCHD as a substitute for VTV or some other explicitly value tilted fund? Let's look at VTV. Here's VTV, which is a Vanguard value fund. So are they a substitute? That I don't know. Let's go to this overlap tool, which only works with ETFs, by the way, at least as far as I know. It is, by the way, etfrc.com. So now that's fascinating. Not showing a lot of overlap, which kind of surprises me. So if we go back to Morningstar, and here's VTV. We're going to go to portfolio for both of these. So the Vanguard fund is a large cap value. Schwab fund is also, oh, that's right. We've lost our blue dot. Someone call Morningstar, tell them they're missing a blue dot, but we're going to assume it's in there somewhere. But what I really want to do is let's first look at sector. So unlike the funds we just looked at, look at technology a lot less because it's a value fund. So you get financial services, for example, banking, right? Industrials, healthcare, right? These are all sort of traditional value type of sectors. And Schwab is, I'm sure, no different. Although Schwab does have a little bit more in tech, but again, a lot in banking and healthcare, consumer defense. If we go to the top 10, Schwab is, let's see, Coca-Cola, Amgen, Merck. There's some overlap, but not a lot. Or, you know, there's a lot of differences. I mean, I think personally, I like both of these funds. We can put them in Portfolio Visualizer just to see how they've done. Well, I like both of these funds. By the way, whoops, what am I missing? Let's quickly, I just want to make sure Schwab is a pretty inexpensive fund, right? As I recall, I don't own either of these funds. Yeah, it's just 6 basis points. All right. So this goes back 10, 11 years. So Schwab has outperformed, not by a huge, well, I guess a fair amount. Again, it's just fascinating because they were neck and neck with Vanguard actually doing a little better for a lot of the time. And then, but after COVID, Schwab has managed the post-COVID crash better than the Vanguard fund. I don't know why. It would be interesting to dig into the details to try to understand why. If we come here and we go and we just started at 2020, we're probably going to see the numbers will be smaller because it's obviously only a couple of years, but the compound annual growth rate is significantly higher because of Schwab's outperformance over the last couple of years. But that's important. So when you look at these and you say, oh, well, it's outperformed over the last 10 years, so I'll just go with that fund. It's important to sort of dig in and say, okay, well, wait a minute. Has it consistently outperformed year after year? Was it, as we looked at a minute ago, is it just because there was 1 year that was really big? Maybe that's why it outperformed. Or in this case, it was post-COVID. And so you might want to dig into that to try to understand why. If you can, I mean, you might look at it. This has certainly happened to me, and I conclude, yeah, I don't know why. I've done my best to try to figure it out. Don't know. Because your ultimate goal, I think, is picking a fund, and I think it's perfectly good to focus on value, but one that you're going to stick with for decades. And but I think both of those funds are good funds personally. Again, I don't own either of them at the moment. I thought about buying some of the Schwab fund, but I haven't done it. Maybe if I win 50 million in the lottery, I'll just put it all in Schwab dividend fund. Okay, Bobby. I have a 401k with a previous employer that's invested in VOYA 2045 target date fund that has an expense ratio of 39 basis points. So that's 0.39%, right? 100 basis points is 1%. I'm currently unemployed, but should I roll this into something? Well, that depends. You could roll it into a rollover IRA, and then if you wanted to, roll it back into a new 401k. Not every plan will allow that, but many will. But the first question is, do you want it in a 401k or a rollover IRA? Now, with a rollover IRA, you have complete control of your investment options. And so you could get a target 2045 fund that's less than 39 basis points. And as a result, I think probably do better. So I'm looking up the VOYA 2045 fund. Let's see if we can find it in Morningstar here. Oh, here it is. I don't know what share class you have, because in a 401k, you might have a different share class. Yeah, it's interesting. You're saying you're paying 39 basis points. I looked up VOYA Target Retirement 2045, and it's only 28 basis points. So I'm not, but you can certainly find a less expensive fund. So like if we go to Vanguard 2045, it's around 14 basis points. Is that what it is? Oh, just 8. Oh, that's right. They lowered. I think they recently lowered. That's just 8 basis points. Of course, you could put these in Portfolio Visualizer to see how they've performed, because ultimately what you care about is the after expense performance, right? So if you're wanting a less expensive fund and you don't have those options, yeah, you could roll it over in an IRA. There could be, depending on your age, when you're retired, there might be reasons you want to keep it in a 401k or not. You want to think of all of those things. Like, for example, let's say you left your employment in the year you turn 55 and you want to take some money out without the 10% penalty. Well, if you meet all the rules, you can do that from a 401k, but you can't from an IRA. You might want to roll it into a future employer's 401k, because that might give you some other options. Those are factors to consider. But if the only consideration is you want a better investment option, then yeah, I would roll it. What I would do is roll it into a rollover IRA, which is different than a traditional IRA. I mean, tax-wise, they operate the same. But if you keep your rollover money separate, one, you might be able to move it into a new 401k down the road if you wanted to. And there's some more protections on that from creditors. Most of the time, might not matter, but all right. Man, I thought I was making good progress. Is a 3% fixed account just as good as bonds? That's from Susan. Well, First of all, we have to decide what kind of bonds we're talking about. But if we're talking about, say, U.S. government bonds, right now 3% is really good. I mean, so with a fixed account, this may be some sort of stable value fund, I don't know, but you're getting the 3%, right? With a bond, in theory, in addition to whatever the yield is, you can earn capital gains if interest rates fall. Most would probably say, yeah, that's unlikely, at least that they'll fall significantly. But if I would be happy with 3%, I can tell you that. I'm real happy with 7.12% with my I bonds. We'll see how long that lasts. Marv says, earlier today, at about 20 minutes, you showed a list of companies in the left margin. When you clicked on one of the companies, a chart of that company would appear. Can you tell us what app? Oh, that's just the Apple stock app. Yeah, I think you're talking about this. Yeah. This is just the Apple stock app. How are we doing today? Oh, this is Amazon. Oh, more or less flat. Yeah, that's what that is. Minnie wants to know, how do you rebalance asset allocation on multiple accounts? Would I include my Roth in the rebalancing? I think you would. I don't know why you wouldn't. I do. And it depends how I'm rebalancing. And what I mean by that is sometimes I rebalance through new contributions. And so it depends on whatever account I'm contributing in, assuming that I'm, well, even if it were a taxable account, let's just imagine, let's imagine that you were contributing to a 401k and you were directing your new contributions to bonds because you needed some more bonds. You might just do it through new contributions over time. Of course, with a 401k, you can always just rebalance anytime you want without affecting taxes. Or if I'm taking, I've got some dividends built up in my cash account at one of our brokers that I just need to reinvest. I haven't done that yet. But when I do that, I'll look at our asset allocation and, okay, what asset class do I need? Now, let's imagine that what I need are more REITs. Well, I don't want to take that money because it's in a taxable account and put it in a REIT. But I might be okay putting it, say, in a total U.S. stock market fund. All right. That's okay. I can go into one of my retirement accounts, let's say a Roth that has a total U.S. stock fund, move that to REITs, or it could be a traditional account, move that to REITs to get my REIT allocation, and then take the new investments and put it in the total stock market. So I'm always sort of looking at the taxes and where new contributions are coming from and which account they're going into. As much as I can, I'll rebalance in retirement accounts as well. If new contributions aren't enough to avoid the taxes. I hope that helps. Marv, I think I've answered your question on the software. I hope I have. Remember, if you want me to cover a topic, tag me. We got 20 minutes left. I'll talk real fast. Minnie says, maybe a follow-up to her rebalancing question. I have she has a small amount in a Roth. She can't add to it. Do I need to hold bonds in it? I can only invest in brokerage accounts. Better than nothing, I guess. Well, I guess I don't understand why bonds. I like to keep equities in my Roth accounts because I want them to grow as much as possible. So that's my approach. And, with a Roth, you're at a broker, Fidelity, Vanguard, Schwab, wherever you are, you should have pretty much complete control over what you invest in. So I get that it's not a large account, but I don't know why that would be relevant to what you invest in and why you would invest in bonds in a Roth account. Questions? Paul wants to know, who is Winston and Strawn? Really? Is Google broken today, people? Does this? Oh, it does say Winston and Strawn. That's my old law firm. So I was a summer associate there, then an associate, then a partner. Then I left. Then I went back as of counsel, which is the title they give old people when they come back to work for the firm. You can also be a partner. This is an important question that Bobby's asked me. If you ever had the chance to call heads or tails at the Super Bowl coin flip, what would you go with? It's always tails. Please. Ridiculous. Okay. The U.S. This is from Vinyl. The U.S. demographics favor low inflation, but also shortage of workers. Aren't those contradictory? I don't know. That was one thing I didn't understand, the logic behind President Biden's, and this is apolitical, trust me. But in the State of the Union, because one way we could fight inflation is to lower wages. But I'm thinking, well, wait a minute. And of course, he was saying, that's not what we want to do for obvious reasons. But I'm thinking, I don't know how you do that. How is that? I don't even know how that's an option. But he said, instead, we need to lower costs. Well, right. I mean, which is to say we need to lower inflation, but wages are costs, right? I mean, they're going up and companies pay them. So, personally, I think there's fiscal policy, monetary policy. But at the same time, I don't know that there's a whole lot our government can do. It could do some things, but it's not as if any president, any administration just wave a magic wand and lower inflation. I mean, obviously, again, monetary policy, fiscal policy has a huge impact on it. But, there are other things outside of our control, I think. Joker, that's the name. I use both Charles Schwab's Intelligent Portfolios and Goldman Sachs' new Robo Advisor, Marcus Invest. Should I combine these taxable accounts and just use one service? Well, for simplicity's sake, I would think so. But the other thing I would consider is how much you have in each. And if we don't have all our assets at one broker. I feel more comfortable having a couple of different brokers. Now, depending on how much money you have, you may say, that's not really a concern right now. Or maybe it is. So that's what I would be thinking about. I'm curious, Marcus Invest, that's one of the robos that I've not really looked at. I'm sure it's perfectly good. I mean, these things are not all that complicated. What's aggressive? Oh, 100% stocks. Yes, that is aggressive. I'm seeing if smart beta. I'd stay away from that. I'd probably go with core personally. So they're 35 basis points. So one question is are they worth it? Like Betterment's 25. I know Schwab is quote unquote free, but as I mentioned, they force you to keep a certain amount in cash. So it's really not free. But my question would be, why not Betterment? Like why is the 10 extra basis points worth it? Or Wealthfront I think is 25 basis points as well. Just a question. But in terms of one or two, I think simplicity is one issue, and then just security for having maybe multiple accounts. At least that's a relevant factor for me. All right. I see you guys reminding people to tag me. I appreciate that. So I am skipping down to where you tag me. I should go back and read all your comments because as I go through them quickly, you guys are saying some good stuff back and forth, including how you'd spend $50 million. Okay, 3-hour tour. Now, I get that reference. 3-hour tour. I'm sure many of you do too. And some of you are like, I have no clue what that's about. Great show. All right. My employer uses John Hancock for their 401k and offers a 100% match on the first 3% of contributions. Oh, interesting. 50% on the next 2%, up to 4%. I kind of get it. I'm not sure I follow all the percentages, but I get it. John Hancock has high hidden fees. Any advice? Well, I don't know how bad the fees are, so that would be question one for you. But I would my hunch would be that the fees can't be so bad that they make the employer matching contribution not worth it. I got to believe the matching contribution is still, even when you factor in the fees, you're still doing better, I would think. But that's how I would look at it. And then, of course, if and when you leave, you can roll it over to a new 401k or a rollover IRA. The other thing you can do is talk to your employer. Again, I did that, as I mentioned, I think in the last stream, and it took some time, and it took a concerted effort from a number of us. And we were professional about it. We didn't go in there and say, "Are you out of your minds? What kind of nonsense is this?" That's what I wanted to do, but I didn't do that. Tommy says, we currently max out our Roth 401k. If I recognize that our modified adjusted gross income will breach the 32% tax bracket, should we change our contributions to a traditional for the remainder of the year? That's an interesting question. Well, of course I can't answer that for you, but I can tell you how I would think through it. And that is, as things stand now, what do you think, what tax bracket will you be in when your RMDs kick in? That's question one. Now, it's not the only question. Unfortunately, you have to just take your best guess, right? Why? Well, because there's too many factors that can change the analysis and you may be, I don't know how old you are. Maybe you're in your 30s, so you got a long way before your RMDs. But of course, tax rates can change. A spouse can pass away. Now you're a single filer unless you get remarried. You could decide when the RMDs start to kick in to use them in part for qualified charitable contributions, and that could change the equation. I mean, there are all kinds of factors that can go into this. Having said all of that, I would give personally, if I hit 32%, because you're making a lot of money to hit 32%, let's look up the tax brackets. I need to write a post on my site for tax brackets so that I don't have to go to NerdWallet every time I want to see the tax brackets. Did you say you're married? You say we, so I'm going to assume you're married. Yeah, so you're making pretty good taxable income. So at this point, and I don't know what state you live in, which would also be relevant, and what state you plan to retire in, which would also be relevant. But I would probably be looking at maybe traditional. At least it would be a consideration. Again, I would want to try to figure out what my RMDs will be and what bracket I will be in, particularly if you're getting closer to retirement. But the real point is there's no one right answer to that question. I can't say, well, you should always do this, or you should always do that. It's really playing the odds, and the higher you go in the brackets, the longer the odds are, right? If you're in the lower brackets, then the question gets easier, although you could still get it wrong, right? I mean, again, to some extent, it's going to depend on circumstances that haven't occurred yet. We don't know what's going to happen. The other thing is I'm just talking this through that I would think about is how much I have in Roth versus traditional right now. You're really heavy traditional. I don't think you are from the sound of your question, but let's just assume you are. I might be inclined to stick to more to Roth. But again, each bracket you go up in, it makes the Roth contribution a little less compelling. So I'm sorry I can't just give you an answer. It's how I would think through it, but there is no answer to that question. Brandon says he was hit hard by cap gains in the Vanguard target date retirement fiasco. We need to call that a name, Vanguard target date fund gate. I don't know. It needs a name. Vanguard allows conversions to ETFs. Do you know if this is true for target date funds? It is not true. I don't think they have ETFs for any fund of funds, whether it's target date, life strategy. I don't think it's an option. You can always confirm with Vanguard, but I'm pretty sure it's not an option. All right. All right. Oh, here's a good question from JG. Based on the time value of money for us boomers approaching retirement, should we consider taking Social Security early at 62 or 63 and minimum withdrawals from retirement account? No pension, but 7-figure nest egg. Well, so, and I don't know, one question is, are you married or not? Because that affects your claiming strategies, number one. Number two, what strategy is going to end up being the best depends on some things that we can't possibly know, like when you're going to die. So you have to understand, kind of like the Roth conversions, you know, we're doing our best to try to figure this out. The next thing I'll say is you do need to think about the tax torpedo on Social Security and IRMA, which is increased premiums for Medicare, and possibly if you're getting credits for the Affordable Care Act for health insurance, right? Now, if I understand your question, you're thinking, well, I'll take Social Security, so I won't have to take as much out of retirement accounts. But of course, I don't know if those retirement accounts are traditional or Roth. Makes a big difference. And so you want to think through the tax implications of taking Social Security early, right? And as you know, if you wait until full retirement, you get, I would say, roughly 30% more, I think. And then from that point to 70, it goes up by, I think it's 8% a year. I don't know if that's an exact number, but. And so, yes, there's time value of money, but if you live long enough, putting aside taxes for a moment, it will make more sense to wait. And so, having said all of that, I would suggest you talk to a financial advisor who can run the numbers. I can tell you, as part of the Schwab thing that I did, part of the Money Guide Pro software that they use looked at Social Security and the claiming strategies involving both my wife. When does she claim? When do I claim? Does she do spousal benefits or not? And even then, though, the output of all of that was not, all right, Rob, do this and you'll be better off, because it depends on things like how long you live. But assuming you live to some planning age, 95, let's say, here's what's best. And you could ask them, okay, well, what if one of us dies at 73? And now what's best? That's what I would do, because the calculations get kind of complex depending on your circumstances. So that's a long answer that doesn't give you the right. I can't tell you this is what you should do. It depends on a lot of factors. Yeah. I will say the Money Guide Pro software was very easy to understand, like the display of it and what they showed. I'll also say, if you wanted to do some of this on your own, let me just show you this. We're back to new retirement, this demo account that I was showing you earlier in the show. I've not spent a lot of time with this, but if you've set up all the information, this takes some time to learn this. I do plan to do maybe like a live stream where we all work through this together, those that are interested, and we just talk about this tool for a couple of hours. But I think it's here. Yeah, so they have Explorer, What Ifs, Monte Carlo, Roth Conversion Explorer, Social Security Explorer. And I've not gone through, anyway, I've not gone through, let's skip the intro and see what we get. So this is all made up data, but it runs through some basic information, and I assume at the end, you've got to have assumptions, and then they give you claiming strategies. So I've not worked through this, but this is fairly comprehensive. So this, I don't know. I mentioned it might be helpful to you. I think there's a link below the video to New Retirement, but if not, it's newretirement.com. I don't know. Someone says, Rob Berger, please look above. Or did they mean above in the chat? They probably did, but I don't know. Oh, I do see them. Okay, I'm looking above. How? I'm like, is someone up there staring at me? Oh, sometimes I watch these videos and I have to say, sometimes I laugh at myself. And it's at me, not with me. Okay. How long would you do a job you hate if you knew afterwards you could retire early? Not long. I'll tell you that right now. I mean, I don't have an answer to it in terms of, 2 years. Depends how much I hated it. It also depends why I hated it. But you've got one life to live. I don't like the idea of spending X number of years hating my life so that afterwards I can retire. The other thing is that I really like the freedom that I can get up each day and kind of do whatever I want to do, more or less. But I haven't really retired. I mean, not in a traditional sense. I'm here. I'm talking to you guys. I don't view this as a job. But this video will make me tens upon tens of dollars. So there's that. But I probably wouldn't last long in a job I hated, personally. Rich wants to know, he's 66, 100% Vanguard index funds, and he wants to know if he's too heavy into real estate, and it's 21%. He's got basically 50% stocks, roughly, 30% bonds, 20% real estate. Well, that's too rich for my blood. But I can't tell you how that's going to look 10 or 20 years from now. You also, I don't know which stocks you have. But 20%, 21% in real estate, that would be too rich for me. But you can always back test this. Let's just look at this for a second. Again, not that this tells us the future, but it's fun. So if we did, here's what we're going to do. We're going to do U.S. stock market. We're going to do U.S. bond market. Where is it? No, I don't want to do 10-year treasury. We'll do total U.S. bond market, and then we'll do real estate, right? And we'll put your portfolio in, which is 51, 29, and 21. Does that equal 100? What am I missing? Well, it doesn't matter. We'll make that 50. Now, what if we have the same portfolio and we'll just do 71. We'll get rid of REITs altogether. Same bond exposure, goes back to 1994, all right? Oh, pretty close, look at that. 1/100 of a basis point difference. Now there you go. I don't know what that tells you. It tells you something. It doesn't tell you the future though. I guess it doesn't matter. That's with 0%. What if, let's try something else. Let's just do 10%, or is that equal 100? Yeah. So we'll do 10% REITs. This is the third portfolio. It won. Not by much. That's interesting. So what that tells me, at least I think it tells me this, but we're going to find out, is what if we got rid of everything but REITs and total stock market? Let's see. Here we go. How have these two compared? Again, since 94. Oh, REITs have underperformed. There must be some rebalancing benefits and whatnot. But when you add them in, it basically turns out to be about the same. I don't know. I don't know what that tells you, Rich, but there you go. All right. How are we doing on time? It's 1 o'clock. All right. Well, I will do one more question. Then I'm going to do one chess puzzle because people like that kind of thing. And the rest of you can go home. I don't know. I'll do one more question. Here's a good one from Lisa. Should I bother maxing out a non-matching 401k? Sure, I think so. If you've got good investment options, whether it's traditional or Roth, you get the tax benefits. You can generally put a lot more in a 401k than an IRA. I mean, there are some exceptions if you have a business and you do something like a SEP IRA, but and it's convenient. It's easy. Right? It comes right out of your check. Gets deducted from your taxes if it's traditional automatically. Yeah, I like it. Oh, and Pretty Chill, I'll just say, likes my keyboard. So I've got two. I'm not sure which one you like. This one's all lit up. This is my gamer bored. I'm not really a gamer. Call of Duty every now and again. Does chess count? I'm a chess gamer, but I don't think they call chess players gamers. All right. Well, listen, thanks for watching. It's 2 hours. I will be back, Lord willing, and the creek don't rise, Monday at 7 p.m. for an hour and a half. And next Thursday, I'm going to do a chess puzzle for those that want to hang out for another couple of minutes. These are tough. I warned you last time. And I'll show you the puzzle. I haven't put it up yet. Actually, this is what the screen looks like. So I haven't created the puzzle yet. I had to hit this button. But I do get nervous trying to solve puzzles in front of you guys because I have to sit there and think, and it's like the show goes dead and there's no talking. Kind of freaks me out, I'm going to be honest with you. And they're tough. I mean, these are not easy. So what's the first thing that just pops into my head is rook g8 check. And the only thing that white can do, by the way, can you hear that knocking above me? That's the work going on in the house. White could interpose the queen, of course, which maybe is not a bad idea. Normally you wouldn't, because rook takes queen. You win. Oh, he can't interpose. What am I thinking? The queen is pinned. See, this is what I miss half the time. The queen is pinned. So the queen. I did not mean to do that. The queen can't. It's pinned. So I like this, but what's the follow-up? He's not going to interpose the bishop. He'll just lose it. So the king goes here, I guess. Of course, I can just win the queen. But see, that's the interest. I'm going to do this. Oh, he does that. Okay. I'm not sure that taking this is right. Maybe it is, in which case it's pretty easy. Queen here. The queen has to interpose. Queen back here, check. Queen has to go there. But I'm not sure what that gets me. Because I can just win the queen. I'd have to win it for, I'm going to take it. No, I'm wrong. So this, I'm guessing. That's wrong too. Okay, so I don't know what I'm doing. I don't know what I'm doing. Oh, I see it now, I think. See, if I move the queen to here, it's check, and this queen, well, the queen can interpose right here. Anyway, I'm pretty confident. No, see, this is why you guys make me nervous. See, and this is what I mean. You guys have already found the answer. I'm looking at it now. It's obvious. Yeah, there's a mate in one, right here. All right, I'm doing another one because that was pathetic. Absolutely pathetic. So if I go queen here, king's got to go up, queen here. Yeah, I think that's mate, right? Oh, he can interpose the queen. All right, there we go. That one was better. Whew. All right. Well, listen, as always, thanks for joining the show. I have a lot of fun doing this, and you guys make it fun with your questions. I'm sorry I can't get to everyone, I know, but I do my best, and we'll be back with it. And now that I'm set up down here, I'll be able to do some more pre-recorded videos as well. I've got a lot on my list. So that's it. Hope you have a great week and weekend. And until next time, remember, the best thing money can buy is financial freedom.